Hello, and welcome to episode 5 of Thick Sustainable Infrastructure Finance. John, we're regularly asked if a fiduciary, like an endowment, CIO, or a pension fund trustee, can invest sustainably. After all, acting in the best interest of the client is frequently measured in terms of financial performance. So, how does that duty allow other factors like sustainability to be considered?
That's correct, Karen. And fiduciary duty cannot be waived under any circumstances. Fiduciaries distinguish themselves by, amongst other things, identifying opportunities to outperform their benchmarks. And we've seen recent examples of sustainability-oriented funds outperforming their peers for select periods. And I'm going to show a few examples on the screen here. So here's an example from Morningstar that shows sustainable equity funds outperform their traditional peers in 2020. So that's a fixed period of time where sustainable equity funds outperformed their peers. Here's another example that ESG-based funds outperformed their peers during COVID. So there are examples of sustainable funds outperforming their peers for discrete periods of time. That's led many in the financial industry to observe an indirect relationship between sustainability and financial performance, as evidenced by a quote from a pension fund fiduciary. Here's the quote: "Positive ESG scoring for security is a factor that demonstrates organizational commitments that lead to a higher probability of persistent returns." That's pretty indirect. And as my statistics professor often emphasized, correlation is not causation. If one looks more carefully, an argument could be made that these securities performed well because of demand, not because of fundamentals. And the Financial Times recently demonstrated that. They tried to evaluate if there was a momentum play going on here. And this screen indicates this ESG performance is flawed because it's very selective about the time periods, and it also fails to acknowledge the fact that there's money in motion to these funds right now, which tends to cause them to appreciate. We've found one situation where this fiduciary duty and sustainability may both be achieved, and that's these thick sustainable infrastructure bonds. When ZCM Sustainability scores an infrastructure bond offering highly for thickness through our proprietary screens, that means the probability of a positive, measurable, scalable, repeatable environmental outcome is high. Water will be preserved, carbon footprint will be reduced, habitat protected, infrastructure along coasts hardened, all done at levels that are consistent with underlying science. This goes beyond and complements environmental impact studies and their level of scrutiny. Now, if you couple that with the financial screens we use for ZCM sustainability and the inherent efficiency of the public bond markets, this often results in selection of an investment-grade security that materially benefits the environment.
So one can potentially invest sustainably and fulfill their fiduciary responsibility through thick, sustainable infrastructure bonds. Are there other examples with such clarity?
Not yet. The academic literature cites many headwinds, such as inconsistent terminology, mixing of material and immaterial issues, lack of measurement standardization, merged approaches, and a lot more. There's a good reference for these from the Stern School at New York University. This screen shows the limitations to trying to extend what we found for infrastructure bonds, thick sustainable infrastructure bonds, to investing in general.
So to the question posed by this episode's title, can sustainable investing fulfill fiduciary duty? In our view, the answer is yes, if it's thick. So we hope that helps you fiduciaries out there who have been struggling to find solutions for your clients' growing interest in investments that address environmental concerns like climate change. Thanks all for tuning in, and more to come on this subject undoubtedly. Send us your questions.